Hey everyone, it's Kenji here, back with some explainer type videos, and today I want to talk about REITs, real estate investment trusts. So you're probably wondering what the hell is a REIT and why should I care? Well, we'll talk about that in this video. So simply put, a REIT is a type of company that invests in real estate on behalf of investors. So for instance, people like you and I and thousands of others can put money in a REIT, and in turn that REIT is going to buy real estate, and with that real estate it's going to get one, rental income, and two, appreciation in the value of the real estate. So those are the two main ways that they're going to make money through that. Now, the reason that you should care is that through a REIT, you're able to invest in real estate. So even if you have a very small amount of money, like say $20 or $100, where you obviously wouldn't be able to pay for an apartment or a house, you can still invest in real estate through this investment called a REIT, right? Now, to give a bit of background, REITs only started around the 1960s by US President Eisenhower. And the idea was basically to give everyone access to real estate portfolios, which at the time was only accessible to the rich, right? The people that had the money to buy real estate, whilst now it's more democratized through REITs. And if you're wondering how big REITs are, they're actually fairly large nowadays. According to BlackRock, out of the REITs that are listed on the stock exchange, they own approximately 2 trillion worth in assets, which in terms of real estate, that equates to around 500,000 properties. Alright, so I want to break down this video into 4 main areas. The first one has to do with the investment strategies that REITs employ. The second one has to do with the types of requirements that are necessary to become a REIT, so we get a better understanding of that. Then we look at whether you should invest, whether it's the right thing for you. And then lastly, we'll look at how to invest if you actually decide to do so. So when looking at the investment strategies, there's really 2 main types of REITs. The first one has to do with equity REITs and the second one with mortgage REITs. So let's first look at equity REITs. And these basically have everything to do with owning a property. So a typical business model for them could be something like buying a property and then leasing it out as office space, say, to a company. And then they would obviously get rent from the tenant, in this case a company, say. And that rent they would basically distribute out to their shareholders as dividends. And that's a basic business model, and that might be for commercial real estate, like what might be office space or shopping malls, hotels, things like that, or residential real estate like say apartments or houses, right? So basically they make money by renting out the property, and another way that they make money, which is more secondary, is through the appreciation of the real estate, right? If the real estate goes up in value over time, that's another way that they've made money. So the second type of REIT has to do with mortgage REITs, and oddly enough, these don't actually own any real estate. Instead, they focus on the financing side of real estate. So it could be things like mortgages, interest rates, mortgage-backed securities, and other things like that. That's what they focus on. So basically, they make their money by earning interest on the investment. And as for which is more popular among the two, it's definitely equity REITs that are more popular, and they're much more widespread basically. So on a macro level, those are the 2 main types of REITs, but they're actually usually focused on a specific industry group. So for instance, there's REITs that focus just on hospitality, so things like restaurants and hotels. Other REITs focus on healthcare, so things like residences or hospitals. There's even REITs for their own prisons, for instance. So there's really a wide array of different REITs. And some are also more geographically focused. So for instance, they invest in a specific country or a specific region. Now, to give you a better idea of REITs, let's look through some of the requirements that they need to qualify as a REIT. There's really quite a few actually, so let me just give you some of the main ones. The first one has to do with investing at least 75% of your total assets in real estate. Another big one has to do with at least having 90% of your income go through to dividends for shareholders. Another one has to do with having a minimum requirement of 100 shareholders, say. And there's a bunch of other ones, but I don't really want to bore you with that. Now, all these requirements seem like a pain, so why on earth would they want to become REITs? And that basically has to do with tax benefits. See, a normal company has to pay what's called corporate tax, and that's usually around the 20 to 30% mark, whilst for REITs, they don't pay any corporate tax at all. And so that's why REITs as a whole have grown so much over time. So now that you have a better idea of what REITs are, let's look into whether you should invest in them. So generally, when you invest in something, you hope that it's going to be something that people are going to want to buy and that is going to be generating money over time. So in the case of real estate, for instance, land is limited, the population's typically increasing around the world, and thirdly, people need a place to live, right? And they probably always will. And so that makes real estate quite an attractive investment. Also, with most real estate, the cash flows are actually fairly stable, right? When you sign a lease, for instance, you know for how long it's going to be and how much you're going to have to pay each month. So from an ownership perspective, that's very good. You can model all your cash flows, and you can see exactly how much you're going to make, right? And if you're curious about the performance of stocks versus REITs, I pulled up this chart for you. You can see here. It basically shows that REITs have actually outperformed stocks throughout a 20-year period. Obviously, in the future, no one knows what's going to happen, but at least in the past, they've done fairly well. So I think of REITs not just as a good investment, but also a good way to diversify, right? Basically, through a REIT, you own real estate, even if, say, you don't have the money to buy an actual house. And so that's a good way to diversify away from, say, just owning shares in the stock market. So what are some of the risks? It can't all be good, right? Well, obviously not. There's some risks out there. I'd say that the main one has to do with picking the wrong REIT, essentially. So for instance, if you pick a REIT focused on healthcare and all of a sudden people stop becoming ill, then you got a problem there, right? Or on the other hand, the one that's actually a real case example has to do with self-storage warehouses. There's been an oversupply of them, and obviously there's not as much demand, and the kind of REIT hasn't done too well. Another risk includes just the general economy, right? When the economy is doing poorly, that basically means that people can't pay their rent sometimes, or they're not willing to buy new property. And so for a REIT, that's obviously not good. And there's many other risks, so I'd say it's worth doing your research on that sense. Alright, so suppose you did your research, you're convinced that REITs are good for you, they're the right investment for you, so how the hell do you invest? Well, basically, it's just like any other share, right? When you buy Apple shares, you probably go through your local broker, and the same applies to REITs, right? You just go through your local broker, and that REITs should be there. So let's look at an example. Here's a list of publicly traded REITs in the US, and let's just pick, say, Boston Properties so you can see. And obviously, just like any other share of Apple, for instance, they also have their share price disclosed, and they have what kind of revenues they made, what kind of industry they're in, and so on and so forth. So it's really just like any other company, except that you're investing in real estate. And if you're not sure which REIT to buy in particular, you can just get an ETF, which stands for an exchange traded fund. And what it basically does is it bundles the REITs for you. And in exchange, you have to pay them a small management fee, which is usually around the 0.2% mark. So it's really quite marginal. A big one, for instance, is the BlackRock iShares Global ETF. So this one just invests in REITs, and depending on the REIT's performance, they have different weights, as you can see here. And as for minimum requirements, there are none. You can just put in $20 if that's all you have, or you can go all in and put 10,000. So yeah, overall, I'd say that REITs have done a great job of making real estate accessible to anyone, regardless of how much money you have. So that's all for this video. Thank you for watching. If you enjoyed it, feel free to like and subscribe, and I'll hopefully catch you in the next one.